Okay, good morning. This next session is from the broker-dealer inspection program staff. I'm Greg McCune. I'm an associate director in the broker-dealer program.
And Steve Attard.
So we're going to go through a few topics of interest, and we're going to also talk a little bit about inspection results, particularly from the 2024 inspections. Before we start, as with any presentation during these programs, we have our disclaimer, the views that we express. Bear with us, I'm sorry. Thank you, Brian. All right. Okay. So again, the disclaimer, the views we express in our official capacity as members of DRI, but are our own, and do not necessarily reflect the views of the board, any individual board member, or any other members of the board staff. So the objectives for this session, at the end of the session, you will be able to understand relevant PCAOB publications for auditors of brokers and dealers, selected observations from 2024 inspections, related requirements of PCAOB standards, and illustrative examples such as audits of broker-dealer financial statements and supplemental information, reviews of broker-dealer exemption reports, and examination of broker-dealer compliance reports. And we'll also touch quickly on our status of 2025 inspection activities. So there are a number of publications that have come out, in particular over the last couple of years, but these go back all the way to 2014, which is in the early years of the broker-dealer inspection program. Certain publications that we'll talk about here will be highlighted elsewhere during our presentation. The audit focus area is for any audit conducted pursuant to PCAOB standards. We'll focus on those audit focus reports that are particular to broker-dealers. I think most people in this room should be familiar with our 4020T annual report. This summarizes our inspection results from the most recently completed inspection. We issued the most recent report in June, and that covered our inspections for the 2024 calendar year. Accompanying our annual report each year is a supplementary document that analyzes our inspection results over time using a variety of characteristics. For example, for audit firms, whether the firm's audited compliance report filers, how many broker-dealer audits the firm performed, and how frequently the firms have been inspected. With respect to individual broker-dealers, whether the broker-dealer is an exemption report filer or a compliance report filer. This past January, we published our first spotlight focusing on the interim inspection program. The spotlight focuses on insights from inspections that may help explain the level of deficiencies we are seeing on inspections. We do not plan to cover these materials in detail during our discussion today. The topics remain the topics remain relevant for auditors and broker-dealers, and we encourage you to read the spotlights if you are not already familiar with them. Finally, about 10 years ago, the PCAOB staff published its staff guidance for auditors of SEC-registered broker-dealers. It's a very detailed document that walks through the application of certain PCAOB standards to broker-dealer audits and attestation engagements. Keep in mind, while these publications summarize and explain certain applicable rules and standards, they are not a substitute for any rule or standard itself. Only the rule or the standard can provide complete and definitive information regarding the requirements. So we'll talk a little bit about, our next code word is 571. Again, 571. Okay, we're going to talk a little bit about results from our most recent inspections. The chart that you see covers trends over the past 3 years, 2022 through 2024. The bar charts on the left depict the trend in the percentage of audit engagements reviewed where the inspection team identified at least one deficiency. You can see there's been an increase over the last 3 years, which, as we stated in our annual report, continues to be a cause of significant concern for us. It's important to understand that these percentages include any type of deficiency identified during the review of an audit. Broadly, we classify deficiencies into one of 2 categories: financial statement and regulatory areas, which include revenue, related party transactions, net capital, customer reserve, et cetera, and then other areas, which includes risk assessment procedures, audit committee communications, and audit documentation. The second and third set of bar charts depict the trend in the percentage of areas reviewed with deficiencies for each of these 2 broad categories. When you focus on those trends, you see the frequency with which we identify deficiencies in an area that has generally been consistent the last 3 years, hovering around 20% for financial statement and regulatory areas, and around 10% for other areas. Those observed deficiencies happen to be distributed over more engagements in 2023 and 2024, which is why the percentage of engagements with deficiencies has increased. The final set of bar charts represent the percentage of audits reviewed where it appeared to be where it appeared to the inspection team that the firm was non-compliant with the SEC or PCAOB rules related to maintaining independence. We noted no such instances in 2024. Okay. Before we get into specific results, I want to talk a little bit about materiality. Establishing materiality involves considering the total mix of information and all relevant facts and circumstances, including both quantitative and qualitative factors. As described in paragraph 2 of AS 2105, determinations of materiality require assessments of inferences a reasonable shareholder would draw from a given set of facts and the significance of those inferences to the investor. Now, in a broker-dealer situation, we typically don't have investors in the same way that a public company would have investors, but I think it's important to think about the owners and other stakeholders as having a similar interest in the results of the broker-dealer. So potential considerations that may be relevant when thinking about materiality for a broker-dealer is, are broker-dealers comparable to issue companies whose shares are available to the investing public? There were in the past a few publicly held broker-dealers. I don't think there are any directly held. There are some that are significant subsidiaries of public companies. What would the typical ownership of a broker-dealer look like? Who are the principals of the broker-dealer? Is it a private holding company? Is there a parent issuer? Are customers typically investors in the broker-dealer? How do key users of the financial statements fit into the definition of a reasonable investor? Who are the other primary users? Typically, it's the SEC, FINRA, CFTC, the exchanges. And what might a reasonable investor consider to be a material fact? Is it effect on earnings, net capital, compliance, or on measuring growth? And then with respect to the total mix of information considerations, you've got to think about all the information that might be available to the users of financial statements, which would include information, the audit opinion, the attestation reports on the exemption and compliance, compliance report and exemption report, the importance of each individual financial statement to a particular user of the financial statement, and then all the other information that might be included in the annual report under Rule 17A5. AS 2105 establishes requirements regarding the auditor's consideration of materiality in planning and performing an audit. Per the standard, the auditor needs to consider the company's earnings and other relevant factors when establishing materiality. The materiality level established generally determines the extent of testing performed by the auditor. including the scoping of the audit, thresholds used in the performance of substantive analytical procedures, and the determination of sample sizes for tests of details. The failure to properly establish an appropriate materiality level for the financial statements as a whole can result in an auditor failing to obtain sufficient appropriate audit evidence to support the audit opinion on the financial statements due to an insufficient extent of audit procedures or not properly identifying significant accounts. Keep in mind that the financial statements as a whole include the statement of financial condition, the statement of operations, the statement of changes in the owner's equity, and the statement of cash flows. Our discussion here is focused on materiality for audits of broker-dealer financial statements. Also keep in mind that AS 2701, auditing supplemental information accompanying audited financial statements, establishes a requirement for the audit of supplemental information and notes that when planning and performing the audit procedures to report on the supplementary information, the auditor generally should use the same materiality consideration as those used in planning and performing the audit of the financial statements. However, if applicable regulatory requirements specify a lower materiality level to be applied to certain supplemental information, the auditor should use those prescribed threshold requirements in planning, performing audit procedures for supplemental information. As noted in the previous slide, AS 2105, paragraph 6, directs the auditor to consider earnings and other relevant factors when establishing materiality. Consideration of earnings and consideration of other relevant factors will depend on the specific facts and circumstances of the broker-dealer. It might be helpful to briefly describe some of what we observed during inspections regarding the engagement team's considerations related to earnings and other relevant factors. These examples are from the facts and circumstances of the particular example we're citing and may not be directly applicable to your broker-dealer engagements. As such, these are just for illustrative purposes, and you need to consider your own facts and circumstances accordingly. Regarding consideration of earnings, we observed engagement teams that have taken into account the earnings profile of their broker-dealer engagements. For example, broker-dealers that were structured and operated as a for-profit entity and that generated significant profits in relation to revenues, similar to public companies. Then there are broker-dealers that are structured as pass-through entities designed to operate at near break-even. For example, a broker-dealer whose sole business was that of a distributor for a parent company's mutual fund offerings. Or there are broker-dealers that report break-even results for financial statement reporting purposes, primarily due to the application of related party revenue or expense sharing agreements or compensation arrangements. Regarding the consideration of other relevant factors, we've observed engagement teams that have taken into account the facts and circumstances of their broker-dealer engagements, including the users of the financial statements, in determining that one or more of the balance sheet or net capital metrics noted on the slide should be considered in establishing materiality for the financial statements as a whole. Consider this example derived from one of our inspections. A broker-dealer reports significant equity and net capital in relation to total revenues and net earnings before tax. In this case, materiality based on factors other than earnings may not be appropriate to plan the nature and extent of audit procedures to test the significant revenue and expense financial statement line items. If that materiality is is several multiples of materiality based on earnings before tax or revenues, a lower overall materiality would likely be more appropriate for the financial statements as a whole in this circumstance. In examples like this, some inspection teams concluded that engagement teams did not obtain sufficient appropriate audit evidence for one or more significant accounts. For example, when engagement teams applied audit sampling and performing tests of details for significant revenue balances. As such, the engagement team's considerations related to establishing materiality contribute to some of the audit deficiencies we will discuss during the remainder of our presentation. Again, the facts and circumstances that auditors should consider when establishing an appropriate materiality will differ between engagements. In all cases, it's important for auditors to document how earnings and other relevant factors were considered in establishing materiality for the broker-dealer's financial statements. Okay, I'm going to turn it over to Steve, who's going to go through some specific results. But before we do, we have our next CPE code, which is 905905.
Greg, in case you were wondering, there was no coincidence that those materiality slides fell into your court. Well, first off, it's great to see some familiar faces out there. I always appreciate the opportunity to engage with you outside the kind of the stresses of the standard inspection form that we usually work with. What we have here are some highlights from our most recent report. But before I get into the details on this, I thought it'd be helpful to share a little context. For the 2024 inspection cycle, we looked at a total of 60 audit firms that covered 102 individual audits. And if you look at our slide, and it's based on kind of focus area. These are the individual areas that we're selecting as part of our inspection process. You'll see that revenue journal entries and evaluating results, out of the 102 that we looked at, in total, these areas came up 97, 102, and 102. And while these are specific to the broker-dealer inspection program, I think you'd probably find a lot of correlation on the issuer side in terms of how often and what the frequencies of these areas coming up. So I think there's some correlation there in terms that you can think about with respect to the issuer side. Selected these three areas, really highlighted these three areas for two reasons. One, there's a pretty good possibility that they're going to show up in the inspection process. And then second, as you can see, the deficiency rates across these three areas are pretty elevated, specifically revenue. If we think about that, we're running at about a 47% deficiency rate on the revenue-related areas. Over the next few minutes, what I'd like to do is share some context, some real detail about what's driving these deficiencies. Then, as Greg and Tony have pointed out already, I'll point out some guidance that we've issued over the last 6-7 months that we hope will begin to address some of the issues or some of the reasons behind some of these deficiencies. And then last, we have as part of this this section, there's a few polling questions we have that are based on some very brief scenarios. And while these scenarios do have a broker-dealer focus, I think the concept behind that could be applied to issuers as well. So I'll start off with revenue. While there wasn't a particular revenue stream that jumped out more than others, so we've identified deficiencies with pretty much most of the major standard broker-dealer revenue streams. And that's your commissions revenue, 12B1 fees, advisory fees from either investment banking or underwriting transactions, and general investment management fees. So all those did come up. There was one common theme, though, that I think really jumped out within the deficiencies, and it was that firms did not adequately respond to the risk of material misstatement at each and for each relevant assertion. And I'll make that as a point of emphasis, that audit procedures need to be designed and performed to address the risks at the assertion level. And from a PCAOB standard, we have 5 assertions: completeness, existence, occurrence, valuation, allocation, presentation, disclosure, and rights and obligations. So those are our 5. Out of those 5, there were really 2 that jumped out more than others. And it was deficiencies related to the valuation and allocation assertions and deficiencies related to the presentation and disclosure assertions. From the valuation and allocation perspective, what that's really getting at is, has the broker-dealer reported the revenue on its financial statements at the appropriate amounts? What's getting there is really just a calculation of revenue. From a broker-dealer perspective, it's basic price times quantity. Testing those key inputs is what we're getting at and where we're finding the deficiencies from a valuation and allocation perspective. From the presentation and disclosure assertion, there's actually a fair degree of correlation between this deficiency and the deficiency related to evaluating the audit results. And I'll try to bring that out in a little bit. But what the deficiency is we're finding on the revenue side is that broker engagement teams are not appropriately, sufficiently testing that the broker-dealers have disclosed the revenue appropriately, or maybe even disaggregated the revenue in accordance with ASC 606. Now, the deficiencies do cover other accounting standards, such as cash flow statements and maybe even fair value. The overwhelming amount of our issues that we've identified really is related to 606 disclosures. So that takes us to our first polling question. Again, this is just a brief scenario. We've highlighted retainer fees, and I think retainer fees are good because retainer fees do cross over. While we see it a lot on the broker-dealer industry, I think it also applies to issuers. And really the key with retainer fees is ensuring either the broker-dealer or issue is recognizing the retainer fee income as the related performance obligations are completed. So I'll go through the scenario here. So a broker-dealer reported M&A advisory fees of $10 million on its statement of income and disclosed the following. Merger and acquisition advisory fees were comprised of $8 million of placement fees and a $2 million retainer fee. Retainer fees are earned on capital placement services and are recognized in accordance with the relevant contract. Retainer fees are non-refundable and offsettable against the placement fees. In other words, they reduce the placement fee. When placement fees are earned, revenue from retainer is recognized when the broker-dealer has delivered the services as detailed in the contract. So there's the scenario. And let's jump ahead to the question. And here's our question. Which is the most significant factor in assessing the broker-dealer's recognition of retainer fees under ASC 606? And this should be pulling up in your on your phones now from a polling question perspective. So is it A, when the retainer fees are received? B, the nature and satisfaction of the performance obligations in the capital placement contracts? C, retainer fees are non-refundable? Or D, retainer fees are offset to reduce the placement fees when the placement fees are earned? Brian, is there a way we could see what the percentage of responses are? Do you know? Or just advance?
There you go.
Oh, there we go. Thanks. Very good. I don't think I need to explain this more. I think you all got the answer correct. It's the nature and the satisfaction of the performance obligations in the capital placement contracts. This takes us to our next scenario. Now, I know the topic itself is very broker-dealer specific, 12B1 fees, but for the folks that also, or maybe the firms that also audit mutual funds, you see this from more on the expense side, and if you don't really focus on the financial services industries at all, if you own mutual funds, you're paying this as an expense as part of your ownership of a mutual fund. This issue, and really the scenario, is actually, again, not going to get too much into the details of 12B1 fees, but rather the nature of the audit evidence that would be required and necessary to actually test a transaction like this. So for the non-broker-dealer folks, just bear with us. I think you'll get the essence of what the scenario is. So here's the scenario. An introducing broker offers mutual fund investments and uses a reputable clearing broker for trade processing. So fairly straightforward scenario that we see with some frequency in the broker-dealer industry. The clearing broker calculates and remits the 12B1 fees to the introducing broker based on the NAV. And the applicable fee rate and reports the 12B1 fees to the introducing broker on a monthly basis and through the clearing statement. The engagement team determined that there was a fraud risk related to revenue recognition and assessed the control risk for 12B1 fees as high. For a sample of 12B1 fees, the engagement team recalculated the monthly 12B1 fees based on the NAV and the fee rate obtained from the mutual funds prospectus. So before I jump ahead to the question, that last bullet point's kind of getting to that valuation assertion I mentioned before. These would be the inputs driving behind the calculation of the price times the quantity. So let me jump ahead to the question. Which of the following provides the most reliable audit evidence to support the NAV? There is a little bit of a nuance here, and I think the folks that do audit brokers and dealers may pick up on it, but we'll see. So, A, monthly customer account statements produced by the clearing broker which show the NAV. An internal spreadsheet prepared by the broker-dealer which shows NAV. A clearing statement from the broker-dealer which shows the detailed 12B1 fees. So the first two focus in on NAV, the last one's on the 12B1 fees, and then D is any of the above. Yeah, great. So monthly account statements produced by the clearing broker, which show the NAV. The key there between A and C is that the customer account statements are what's being sent to the customer. So the view is that that actually may be more of a kind of a third-party evidence, where a clearing statement that's produced by the clearing broker, which in turn the broker-dealer is really just recording that information on his trial balance, is not quite wouldn't be considered the most reliable audit evidence. It is audit evidence, but from the examples that were there, it was the customer account statement. So good, I'm actually glad to see such a high response on that question. So the second area where we've identified a fairly elevated deficiency rate was on journal entry procedures. Up here on the screen, we have the common deficiencies, good practices. Essentially what we did here is I cut and pasted those out of our audit focus report on journal entries. And these really outline kind of the key things and themes that were reported in our staff guidance. I'm not going to go through each of these individually because I think it would be a little more informative if you looked at the document, because within the document, not only do we outline these two categories, but there's also some reminders which provide some pretty good detail into considerations as you're going through and performing your audit procedures on journal entries. But maybe just a brief comment regarding to the deficiencies we've identified from broker-dealer perspective related to journal entry testing. I think that the two most prominent or prevalent deficiencies we found from a broker-dealer perspective was one that firms were actually not testing journal entries, or not examining the underlying support that went along with those journal entries that were selected for testing. And the second one that came up with some frequency was that audit firms were not sufficiently defining the characteristics of the population they were looking at. So in other words, we would see some general characteristics such as we're going to look for unusual transactions without actually defining what they would consider an unusual transaction. So this is just what the cover page of our audit focus for journal entries looks like. It's the same theme through, I know Tony had mentioned, we just recently issued a broker-dealer audit focus, which was our first in what we hope to be a series of audit focuses on the broker-dealer industry. And again, it kind of has that same look and feel. And they all have the same really theme too. We're going to outline the applicable standard, then underneath the standard, there'll be some common deficiencies that we're seeing, and then after that, it's kind of really what the guidance is to the extent that we have there, and these are the reminders, kind of what to think about as you're going through and performing those journal entry procedures or whatever the topic of the audit focus is. And then lastly, there's some observations that we call, good practices that we've seen where firms that didn't have deficiencies, these are some of the things that were in place in those instances. All right, that takes us to our next code word, which is 669. Evaluating audit results. What this is getting at is these are deficiencies that are cited under AS 2810. And while AS 2010 really gets to the requirements to determine whether the audit evidence overall obtained is sufficient and appropriate to support your opinion, where we're seeing a lot of deficiencies is under one specific subsection. It's like paragraphs 30 and 31. And not to get caught up in the paragraphs, what this area is the procedures to evaluate the presentation and disclosures in the financial statements. And as I mentioned before, when I was talking about the revenue-related deficiencies specific to the presentation and disclosure assertion, this is where it crosses over. So in instances where audit firms don't perform enough or sufficient and appropriate audit procedures over the presentation and disclosures, where that generally goes is to situations that appear that the broker-dealer's financial statements may be materially misstated. And again, the key and overwhelming accounting standard that's cited here is ASC 606. And more specifically, it's disclosures of the performance obligations related to the material or significant revenue streams that do not appear to be disclosed within the financial statements. And that includes nature of those services, when the broker-dealer is satisfying those, and how the broker-dealer is satisfying those performance obligations, whether there's variable consideration or any constraints. So maybe as a suggestion or an idea, if you take a look at the income statement, compare it to the disclosures and notes, make sure that those income statement items are appropriately disaggregated, and from there, if they're disaggregated, are they appropriately disclosed, and does it include all the required elements in accordance with ASC 606? That by far is probably the most referenced audit standard, accounting standard within these type of deficiencies. Again, as I mentioned before, cash flow questions do come up or deficiencies come up, and then we still see an occasional fair valuation issue that again comes up and appears that the broker-dealer may have materially misstated their financial statements.
Okay. Before we get into segment report, I just we get a lot of questions in the field about disaggregation. We see that a lot. In the 606 is somewhat vague as to what the expectations are with regard to disaggregation. But what I would encourage you to do is maybe take a look at the broker-dealer's supplemental statement of income that they file with FINRA. That has a much more detailed requirement as to how revenue should be broken down and reported. And I think that provides, while it isn't necessarily definitive, I think it does provide a good roadmap, a good starting point for maybe how you should look to see the revenue disaggregated in the GAAP financial statements. So with regard to segment reporting, for 2024, we had a new requirement for fiscal year ends 12/31/2024 and after. We had a new requirement for disclosures around segment reporting. Kind of an interesting thing. A lot of engagement teams did not necessarily think about segment reporting as being applicable to broker-dealers. Some of it was because people thought, well, broker-dealers are typically private companies as opposed to issuers, as we understand those terms. However, broker-dealers are, in fact, considered to be a public business entity, which is essentially any entity that files registrations, is registered with the SEC and files financial reports with the SEC. So broker-dealers would be considered a public business entity under that definition, and therefore segment reporting has actually always been applicable to broker-dealers. However, most broker-dealers do consider themselves to be a single business segment, so most of the disclosures related to the segment standard are not applicable or aren't necessarily material or meaningful. However, there was a new requirement in 2024 that required certain disclosures even for those entities that consider themselves to be a single segment, and those include that the the entity had to disclose significant segment expenses that are regularly provided to its chief operating decision maker and included within the reported measures of a segment's profit or loss. They had to include the title and position of who that chief operating decision maker was, and then also describe how the chief operating decision maker uses the reported measures of a segment's profit or loss to assess segment performance and decide how to allocate resources. So this here is an example of a disclosure following the updated requirements in ASC 280. It's fairly detailed. Maybe your situation wouldn't necessarily require this level of detail, but this does cover all the required items, and we think it's a good template to use. This was taken from, it has been modified a little bit, but taken from an actual broker-dealer filing. Okay, so next is we have our next code, which is 680. 680. Okay, so going back to areas where we've had elevated deficiency rates over the past couple of years, the next area we wanted to discuss is related party transactions, which are covered, the relevant auditing standard is AS 2410. And so the types of deficiencies that we've seen include not testing the allocation of revenue and expenses between a broker-dealer and its parent or affiliate, not evaluating whether allocated revenues or expenses were consistent with the terms of the agreements between the broker-dealer and its parent or affiliate, not evaluating the financial capability of the parent or affiliate to satisfy any due to, due from the broker-dealer, not identifying any omitted or inaccurate disclosures necessary to understand the effects of related party transactions, and then not communicating to the audit committee the auditor's evaluation of the broker-dealer's identification of, accounting for, and disclosure of related party transactions. So related party transactions are going to be the focus of a soon-to-be-released broker-dealer audit-focused document. So we just recently, in the last week or two, released one on exemption reporting and AT2. The next one in the pipeline is on related party transactions. Not 100% sure when that's going to come out, but hopefully soon. Like other documents in the audit focus series, this audit focus will highlight good practices and key reminders for auditors from the PCAOB standards related to testing of broker-dealer related party transactions, journal entries, and provide the staff's perspective on common deficiencies made by auditors. The bullets on the slide you see here provide an outline of the key reminders and good practices in the soon-to-be-released document. We encourage you to read the document when it comes out and consider how it may help you improve your audit approach in the area of related party transactions. So we're going to walk through a little bit of a case study on related party transactions and auditing them. So I'll briefly read the scenario, and then we'll have a polling question. So the broker-dealer is a member of FINRA and subject to an intercompany expense sharing agreement with its parent and other affiliates where certain indirect expenses incurred by the parent are allocated to the broker-dealer and other affiliates. Indirect expenses subject to allocation are initially recorded in the general ledger of the parent. The parent allocates these expenses to the broker-dealer based on a methodology per the agreement. And the engagement team determined that there was a risk of material misstatement related to allocated expenses. So I'll give you just a second to read that. So with that information, if you could take a look at these questions and determine what would be the best response. Just give it a couple more seconds, let people respond. Okay. Okay, an overwhelming response for D. I think most people have been to these before and know that when all of the above is one of the options, I would say there's probably a 95% likelihood that that will be the answer. So the correct answer is A, a combination of the above procedures. I'll just briefly touch on why some of these other answers on a standalone basis may not be enough. So answer A, inquiry alone is generally not considered to be a sufficient response. Answer B, the engagement team should generally perform procedures to evaluate the total expenses recorded by the parent that are subject to allocation. Answer C, with respect to reasonableness, brokers or dealers that are FINRA members are subject to FINRA notice to members 0363, which requires a broker-dealer to make a record reflecting each expense incurred related to its business and any corresponding liability. It states that one proper method is to record the expense in an amount that is determined according to an allocation made by the third party on a reasonable basis. Therefore, the reasonableness of an expense allocation methodology is a relevant risk when there is a risk of material misstatement associated with allocated expenses, as there is in this example. So, again, good job. Most people got that right. So with that, I think I'm turning this back over to Steve to talk about some other areas where we've had deficiencies.
This is actually supplemental. Sure.
Oh, I'm sorry. I apologize. My mistake. Okay, so we do actually, so another area that we had some deficiencies is in supplemental information. This is your net capital and your customer reserve, PRC, et cetera. So Regarding the audit of supplemental information required to be included in a broker-dealer financial statements, the percentage of engagements in net capital deficiencies related to supplemental information decreased in 2024 compared to 2023. However, the percentage of engagements with customer protection rule deficiencies related to supplemental information increased in 2024 compared to the prior year. Supplemental information is required to be included in broker-dealer annual reports by the Customer Protection Rule and the Capital Rule, 15C33 and 15C31 respectively. The Customer Protection Rule requires the presentation of supplemental customer reserve and possession or control schedules in broker-dealer financial reports, and the Net Capital Rule requires the presentation of a net capital schedule. The applicable PCAOB auditing standard is AS 2701. Generally, our deficiencies fall into two broad categories: either insufficient procedures to test the completeness and accuracy of the information presented in the schedule, or insufficient procedures to evaluate whether the amounts were consistent with the applicable regulatory requirements. So in terms of the next area we wanted to touch on is non-compliance with PCAOB standards. So these are areas sort of outside the core financial statements, audit procedures that have to be performed to support the overall audit. And you can see there's a number of categories here. The number of audits that we look at is 102 in the past 2 years. And we've had, with regard to auditor communications, we've had 21 engagements with deficiencies. These most frequently involved instances when firms did not communicate to the audit committee or its equivalent. And keep in mind, even if for broker-dealers that tend not to have a formal audit committee, the rule does contemplate those scenarios and identifies either management, ownership, or the board of directors as possibly an equivalent. So essentially those charged with governance is the term you might hear. So did not communicate to audit committees or their equivalents all significant risks identified during the risk assessment procedures in accordance with AS 1301. There was 19 instances where engagement teams did not sufficiently identify and assess risks of material misstatement. Most frequently, these involved instances where firms did not make the required inquiries or any inquiries of all of management, broker-dealers, audit committee, or others charged with governance, an internal audit function if applicable, or others in the broker-dealer about the risk of material misstatement. Just a point on the others, that is in AS 2110, you'll see there is a requirement to consider inquiries of others outside of the financial reporting management. Each situation has to be evaluated on the facts and circumstances, but for example, for an introducing broker-dealer, you might consider somebody on the sales side, such as registered rep, as somebody that you may want to make those inquiries to. Next item would be audit documentation. We had 11 instances with deficiencies related to that. Typically, those are instances where the engagement team failed to assemble a complete set of work papers within 45 days following the report release date. And then the last item, excuse me, not the last, the second last item is auditor's report on the financial statements. These are deficiencies in the actual report or the opinion itself. These range from situations where the engagement team didn't appropriately identify all the relevant financial statements. They actually failed to express an opinion or disclaim an opinion on the supplemental information, even though the supplemental information was in fact audited. And then the last item is auditor independence. Now this is different. We said earlier that there were no deficiencies related to compliance with SEC and PCAOB rules with regard to independence. So in other words, we didn't see any situations where firms had violated their independence, but these are situations where the firm may not have done sufficient procedures to evaluate whether or not everybody performing the audit was in fact independent. including people from outside the firm, whether it's an external EQR or if some work is being outsourced to another firm. Their firms need to verify, confirm their independence as well. So our next code number is 841841.
So the next, here's just another example of the guidance that the division is putting out, again, to help auditors in some areas where there's been some common deficiency or so maybe an elevated deficiency rate. So audit committee communications, this was an audit focus that was published earlier in the year, and it just goes through very similar format. It identifies the standard, goes through some common deficiencies, points out some reminders, and then also some good practices. So that takes us to the results. Again, another slide on the results from our attestation engagements. But maybe by way of background, since we do have a mixed group, the broker-dealers are required to include one of two additional reports to their annual financial statements. It's one's referred to as the compliance report. The second is the exemption report. And auditors are required to issue two types of, one of two different reports. One's an examination report on the compliance report, and that would be in accordance with AT1. And the second would be a review report on the exemption, on the broker-dealer exemption report, and that would be in accordance with AT2. And just in general, as you see, there are some pretty elevated deficiency rates on these two attestation reviews. And I'll go through some of the details over the next couple of minutes. From a review engagement perspective, and this would be procedures performed in accordance with AT2, we looked at a total of 64 review engagements out of the 102 total population. And we have, as we pointed out before, that we have a pretty elevated deficiency rate. But that deficiency rate, kind of to provide some more context, is concentrated in three areas. Oh, we'll get to those areas in a second. So here's our next code number, 724. Just jumped ahead. Yeah, so really one of the bigger deficiencies that we picked up, or maybe one of the more prevalent deficiencies we picked up, is evaluation of audit evidence. There's some similarities to what I mentioned before when I was going through evaluating audit results. But the focus here is just maintaining skepticism and analyzing the extent of the procedures that were performed in connection with the audit and thinking how that could or may impact the broker-dealers. Statements they included in their exemption report. I'll kind of highlight, maybe just read from the slide here, because I think the first piece is very important. AT2.10, paragraph 10, requires the auditors to evaluate whether evidence obtained in the results of those procedures performed in the audit of the financial statements and the audit procedures performed on the supplemental information corroborates or contradicts the broker-dealer's assertions that's included in either their compliance report or their exemption procedures. What we're getting at here is think about the broker-dealer's operations and business activities. As an example, if a broker-dealer claims an exemption under K2II, which indicates that their activity is going to be processed through an independent clearing broker, are there any business activities, are there any revenue streams that are outside of that activity? The ones that pop up with more frequency are when a broker-dealer may sell, may sell insurance products. And those insurance products are directly with the insurance company, or mutual fund product, which is directly with the mutual fund company. Those revenue streams would be considered, or maybe outside the activities that are being processed through the clearing broker. So if the broker-dealer only has claimed an exemption under K2II, but you see some of this information within your testing of the income statement, AT 2.10 is really requires the auditor to think about these activities and see if that activity that they picked up on may contradict the statements the broker-dealer included within its exemption report. And that's a general example, but it is something that we do see with some frequency and contributes to the elevated deficiency rate. Inquiries is another area where there's a lot of evidence or a lot of deficiencies we've identified. And it's not that audit firms aren't performing the inquiries. For the most part, a lot of the audit firms that do perform these attestation procedures actually do a pretty good job in indicating that they are performing inquiries. It's the sufficiency of the inquiries. You know, specifically, there's a requirement within the standard that the auditor should make inquiries to individuals who have relevant knowledge regarding the controls relevant to compliance with the exemption provisions. And these include the controls over prompt transmittal of those customer funds. So that's the piece that tends to be missing, is going to that next level and identifying the people at the broker-dealer who have that knowledge about those controls. And the last category, or really predominant category of issues, is reporting on and review engagement. The auditor's review report must include the required elements identified in the standard. I know it's a pretty high-level statement, but in a lot of firms, especially smaller firms, will use guidance and information that's coming from third-party audit providers, and sometimes those templates that are provided are missing required elements. So I think it's important, as you're drafting your audit reports, just go back and make sure that all the requirements under 2.16 are included within your audit report. The second piece is to ensure that the audit report accurately identifies the broker-dealer's assertions. We do see with some frequency where a broker-dealer may claim exemption from a particular, under, say, K2II, but the auditor's report will reference K2I, or maybe a broker-dealer indicates that they're claiming some relief under footnote 74, and the auditor's report may be silent to that. So it's important to think about and make sure your audit report aligns with the statements that the broker-dealer has included within its exemption report. So that takes us to our next scenario. The broker-dealer disclosed in its financial statement that it cleared all customer transactions through an unaffiliated clearing broker on a fully disclosed basis and did not carry customer accounts or perform custodial functions related to the customer's securities. Okay, so the first one is disclosure in the financial statements. Second bullet point, the broker-dealer included the following statements in its exemption report. It claimed an exemption from K2II the exemption provisions. And second, it met the identified exemption provisions throughout the year, except in 2 instances where customer checks were not promptly transmitted to the broker, to the clearing broker. So, based on that scenario, which of the following statements would be inappropriate for the auditor to include in its review report? We've reviewed the management statements included in the accompanying exemption report in which the broker-dealer stated. All right, 50%, yeah. So the correct answer is D. Each of those statements would be inappropriate. The broker-dealer did not directly or indirectly receive, hold, or otherwise owe funds or securities to customers. That was a statement in the financial statements. Answer number A is it claimed an exemption from K2 single I, claimed an exemption from K2 double I. And then lastly, the broker-dealer met the identified exemption provisions throughout the year without exception. In this scenario, it did indicate that there are 2 exceptions. With respect to examination engagements, these are the procedures auditors perform in accordance with AT1 regarding the compliance review. Look at the number of engagements reviewed, 29. We don't see this, we don't inspect these too often, mainly because it's just a smaller population of broker-dealers that are filing compliance reports.
Yeah, just from context, there's about 3,300 registered broker-dealers. There's about 160, 170 that file compliance reports.
Just go through a brief scenario on AT number 1 and an ICOC context. So in this scenario, a broker-dealer used a service organization for trade processing and maintenance of customer account information and the broker-dealer stock record. The service organization generated the securities deficit report that the broker-dealer used in the performance of controls related to compliance with the possession of control requirements. The auditor determined that the controls at the service organization were important to its conclusion about the broker-dealer's ICOC. The service organization's SOC 1 report provided evidence of the design and operating effectiveness of controls over the completeness and accuracy of the securities deficit report. The auditor determined to rely on a SOC 1 report for evidence regarding controls over the securities deficit report. So I know this is a pretty narrow scenario as it's kind of referencing AT1, but if you think about the broader context, information being produced by a service organization, an assessment of the service organization report, whether you're going to rely on those controls or not, and ultimately relying on a report generated from the service organization. So here's a question. Which of the following statements would be incorrect? Don't select answer number A. Tricky wording. Which of the following statements would be incorrect? As the securities deficit report is referenced in the SOC 1 report, the auditor does not need to perform any additional procedures. Yeah, that would be the actual incorrect answer. And Lastly on our section is just a quick update on our 2025 inspection status. From a selection perspective, that's actually been completed. The extent of our selections, I mentioned what the scope was last year, 60 audit firms and 102 different broker-dealer audits. Our plan is very similar this year. As far as the field work, you're starting to see a bit more in-person inspections. You'll see that trend continuing to through next year. And then lastly, we'll anticipate our annual report for the 2025 inspection cycle to be issued no later than mid-June 2026. That takes us to the end of our prepared remarks.
Okay. That's it. Thank you. Appreciate your time.
How do we get to them? Sorry.
So there may be a couple of questions that we'll try to address. So the question is, if the expense sharing agreement specifies that allocations are based on the related party's revenue, but we neither audit the related party nor is the related party audited, would obtaining the parent company's financial statements be sufficient to support the allocation basis? If the related party is unwilling to provide its financial statements, could we instead obtain a written confirmation from the related party's management attesting to the accuracy of the reported revenue? I don't think just getting a copy of the audited financial statements in and of itself would be sufficient. I think, unfortunately, like a lot of answers that come up in these situations, it really is facts and circumstances. And you, as the engagement team, you need to assess the reliability of the information that you're getting, and what procedures do you need to do to be confident in the completeness and accuracy of that. And I appreciate that there can be some challenges in that scenario. But Steve, I don't know if you have any insight. I don't know that there's necessarily a silver bullet I can give you here. And this is certainly a challenge for a lot of engagement teams. But I would say you do need to look at the underlying detail to assess, again, whether the completeness and accuracy of the information that the broker-dealer is using to record information in its books and records. So the next question, in your professional opinion, so this must be for Steve, what is the best practice for determining materiality for an audit of a BD which is designed to break even each year? Well, I don't think it would be appropriate without knowing the facts and circumstances of any individual situation. But you have to look at the considerations that we discussed. What's relevant to the users of the financial statements? Would using a measure other than earnings, such as assets, net capital, equity, would that give you a distorted materiality that could inappropriately affect thresholds used for substandard analytical procedures or sample sizes for detailed testing? So I don't think there's necessarily a best practice to follow there. Again, you have to look at use your professional judgment and consider the facts and circumstances of the broker-dealer you're looking at, as well as the intended users of the financial statements. And the third question we got, for the deficiencies in revenue assertions, is the problem that firms are not identifying the proper assertions in the risk assessment, or are they just not following through with the appropriate procedures, or both? We certainly do see situations where the risk assessment is insufficient, and we also see situations where firms haven't, engagement teams haven't necessarily done a sufficient job in really understanding the flow of information to record revenue amounts, and therefore, design audit procedures that are appropriate in the circumstances. But more typically, it's really just not doing enough work, whether it's, not testing the calculation of revenue amounts, such as, rate times volume, or not picking a sufficient sample size, in particular not following the requirements of the sampling standard. They're not considering tolerable misstatement. They're not considering the risk of incorrect acceptance. Auditor judgment is a fine and appropriate tool, but when you're eyeballing a sample size because it looks good, that oftentimes is not going to give you a result that's going to stand up to scrutiny. So I don't know if you have anything you want to add to that.
No, I think you covered it.
Okay.
I'm glad you took that materiality question.
Yeah. All right. Well, again, thank you. Appreciate the questions. And I think we're break, Brian, if I'm not mistaken.
Yeah, so we are going to take, I know the agenda called for a 10-minute break. We'll actually take a 15-minute break, and we'll reconvene at 11:20 here in the room and the appropriate time wherever you are online for our next session. Thanks.